Okay, I want you to picture a number for a second. $400 billion.
It's hard to even visualize, isn't it? It feels like it should have its own gravity.
It really does. I mean, 400 billion, that's about the GDP of a country like Denmark. A whole country.
But we're not talking about a nation state.
No, we are talking about a single company. As of the 2025 fiscal year, Alphabet, Google's parent company, just topped $400 billion in annual revenue for the very first time.
And the number itself is staggering. It is. But if you just focus on the cash, you actually miss the real story.
You miss the shift happening underneath.
Exactly. There's a fundamental change happening in the company's DNA right now.
Right, because for 20 years we've known them as the search king. You type something, you get the 10 blue links, you click one. Simple.
And Google gets paid. But that era, the blue link era, feels like it's officially closing.
It does. Management is using this new term all over their reports, the agentic era.
Agentic. Yeah, and it sounds a bit like, corporate buzzword bingo at first.
A little bit.
But it's actually describing a very real technical shift. It's the difference between a tool that just gives you information and a tool that actually takes action for you.
So it's moving from Google, how do I book a flight, to
Google, book me a flight to Tokyo. I need an aisle seat and keep it under $5,000. And the AI just goes and does it.
Which is equal parts amazing and terrifying. But before we get into the sci-fi stuff, there's a twist in the financials that I think caught everyone by surprise.
A Buffett surprise.
Warren Buffett.
Yeah.
Berkshire Hathaway, the guy who famously steered clear of tech for decades, saying he didn't understand it.
And yet, Q3 2025, they drop a filing and boom, a $4.3 billion stake in Alphabet.
It just begs the question, why now? After all this time, what does the Oracle of Omaha see in Google today?
Is he seeing a value play the rest of us missed?
Exactly. Makes you wonder what signals he's tracking. And actually, speaking of tracking the market, if you want to get that broader view, sort of see the whole market temperature like he does, you should check out the iOS app Buffett Indicator. You can just search for it on the Apple App Store. A pretty neat tool for that macro perspective.
That context is always important. And that's our mission for this deep dive, right? To figure out if Buffett is right. We need to look under the hood of this nearly $4 trillion giant.
Is it a value play? Is it a growth trap? Or is it just the future of the economy?
Well, let's start with the money. You called this section the money machine for a good reason.
I did. So we mentioned the annual figure. But let's zoom in on the latest quarter, Q4 2025. What did the numbers actually look like?
It was a blowout, just a monster quarter. $113.8 billion in revenue in just 3 months.
And that's up 18% year over year.
It is, which for a company this size is just incredible growth.
But where's it all coming from? Is it still just us clicking on ads?
Mostly, yeah. Advertising is still king. Search and YouTube together make up about 80% of that. But, and this is the big but, there's a major shift happening just below that. We have to talk about the cloud.
Google Cloud, which for the longest time felt like this expensive hobby, just a money pit trying to get you up to Amazon and Microsoft.
Oh, it absolutely was a money pit for years. But the turnaround is complete. In Q4, Google Cloud revenue surged 48%.
48%.
Wow. But the revenue isn't even the headline. It's the profit. For the first time, it's a real profit center. It generated about $3.6 billion in operating profit for the quarter.
That's a huge swing from where they were.
It is. Margins are up to nearly 24%. They've grabbed about 13% of the whole cloud market. This isn't a side project anymore. It's a primary engine of growth.
And what about YouTube? I saw a number in here that it blew my mind. YouTube ads alone brought in over $10 billion.
Just think about that. The ad business for YouTube, on its own, is bigger than the entire revenue of huge companies like Netflix just a few years ago.
And that's before you even get to the subscriptions.
Right. YouTube Premium, YouTube Music. That's all bundled into this subscriptions, platforms, and devices segment, which is now a $12.8 billion business.
So the cash register is just ringing off the hook. Net income up 30% to $34.5 billion, a net margin of almost 33%.
They are printing money. But having money is one thing. Keeping your dominance, that's another.
Right. And this is where we have to talk about the moat.
The moat.
Yeah.
The thing that protects your castle.
For Google, that's always been search. Their market share is still, what is it?
Still sitting around 92%. And don't forget, Android is on 70% of all smartphones. That is a very, very wide moat.
But the fear, and this is what hammered the stock back in 2023, was that AI chatbots were going to come and drain that moat.
That was the narrative. Why click a link if ChatGPT can just give you the answer? If I get the recipe directly, the food blog doesn't get a click, and Google doesn't get to show me an ad.
The whole business model is at risk.
In theory. So how are they defending against it? With infrastructure. This is what Buffett would call the alligators in the moat.
Alligators.
Yeah.
I like that.
Yeah.
So what are the alligators here?
It's the physical scale, the data centers the size of small cities, the undersea cables they own that wrap around the globe, the custom chips they design.
So a startup might have a smarter AI.
Maybe. But they can't afford to run it at Google's scale. They can't compete on the cost per query. That cost advantage is the alligator. It just eats the margins of anyone who tries to compete.
And they're not standing still. They've got Gemini 2.0, this deep research thing, which brings us back to that agentic shift.
Right. It's all connected.
Okay, so explain it to me. What does that agentic experience actually look like for a user?
Okay, let's use an example. Right now, if you want to plan a family trip to Tokyo, what do?
I open about 50 tabs on my browser. I Google hotels, then flights on another site, then the subway map, then restaurants. I'm the one putting it all together.
Exactly. You are the project manager. It's a lot of work. In the agentic era, you just give the AI the prompt. Plan a trip to Tokyo for 4, keep it under 5,000, make sure the hotel is near a subway.
And the agent does the rest.
It goes out, it checks the sites, compares the prices, synthesizes all that information, and just presents you with a finished plan. It executes the task for you.
It's the difference between a librarian pointing you to a shelf and an assistant writing the report for you.
A perfect analogy. And this is where Google has an insane advantage. The data flywheel. They already have 2 billion people using their AI overviews every month.
And every single interaction is making the model smarter.
It gets better, which attracts more users, which makes it even better. It's a self-reinforcing loop that no startup can match. They just don't have the user volume.
I also saw a note about something called the Willow chip. Sounds like science fiction.
It's very real. And it's a huge deal in quantum computing. So the big problem with quantum computers is that they're unstable. They make a lot of errors.
Right. Fast but unreliable.
Exactly. The Willow chip is a breakthrough that reduces those errors exponentially. It makes usable quantum computing much, much closer to reality. It shows they're not just thinking about next quarter, they're playing a game that lasts decades.
Okay, but building that future costs a fortune. And this brings us to the most shocking number in the entire report, the spending.
The $93 billion question.
Yeah, CapEx. Capital expenditures. Between $91 and $93 billion planned for 2025 and 2026. That is just, it's an unbelievable amount of money. Is it reckless?
It's a huge bet. There's no other way to put it. To give you some context, about $30 billion of that is just maintenance, keeping the lights on.
So over $60 billion is pure aggressive growth spending.
Pure aggression. They're building what they call the AI hypercomputer, massive new data centers, filling them with their new custom Trillium chips, and building the power plants to run it all.
But why so much? Why $93 billion?
CEO Sundar Pichai said it himself, and it was a great quote. He said, "The risk of underinvesting is dramatically greater than the risk of overinvesting."
Unpack that for me. What does that really mean?
Think about it. What's the worst case scenario if they overspend? They burn a few billion, their margins dip for a year or two, shareholders get annoyed.
Okay.
Now, what happens if they underspend? If they miss this AI infrastructure wave, they become irrelevant. They become Yahoo. They become a legacy company.
So this is an existential bet. They'd rather waste money than risk becoming obsolete.
Exactly. They have the cash, so they're using it as a weapon to guarantee their spot in the next era of computing.
Okay, so let's talk about the stock itself. We know they're making money. We know they're spending money. But if I want to buy a share today, is it a good deal? Let's do a deep value inspection.
This is where it gets really interesting. On a great company checklist, they pass with flying colors. High margins, check. Huge cash pile with low debt, check. A return on invested capital of around 40%.
That's incredible.
It's an amazing business. But the question is it a cheap stock?
Kansas.
By the classic strict value metrics, no, not at all. The PE ratio, the price to earnings, is sitting around 33. That's historically high for them.
A value investor usually wants something under 15.
Exactly. So on that front, it looks expensive. But there's a nuance here. If you look at the PEG ratio, which is price divided by earnings growth, it's actually pretty low, around 0.6.
Because the earnings growth was so massive last year.
Right. And anything under a 1.0 PEG ratio suggests a stock might be undervalued relative to its growth. It's not a bargain. It's growth at a reasonable price.
Okay, but let's get to the brass tacks. The discounted cash flow analysis. What's the actual intrinsic value according to the math?
Okay, so let's run the scenarios. First, the zero growth scenario. Alphabet never grows again. It just makes what it makes now, forever. In that world, the stock is worth about $60 a share.
And it's trading at $330. So that's not what the market thinks.
Definitely not. So let's try a conservative view. Let's say 5% growth per year, just keeping up with the economy. That gets you to an intrinsic value of about $90 a share.
Still way, way below the current price.
Way below. Okay, so now the nominal case. Let's assume a healthy 12% annual growth for the next decade. That model spits out a value of around $148 per share.
Wait a second, $148, but the stock is at $330. That's a massive disconnect. Is the math telling us this stock is wildly overvalued?
The math is telling us that the market is pricing in explosive growth well above 15% a year for a decade straight.
Yeah.
Or investors see Alphabet as such a safe haven that they're willing to accept a much lower future return.
But either way, it's priced for perfection. The agentic era can't just work. It has to be a home run.
A grand slam. There is no margin for error baked into that $330 price tag.
And that feels risky. Speaking of risks, who is actually in charge here? Who's making these huge bets?
Ultimately, the founders, Larry Page and Sergey Brin, even though they're not involved day to day, they own the special Class B shares.
Which gives them all the voting power.
It gives them about 51% of the vote. So even though they only own about 6% of the equity, they have total control. Shareholders can't force any changes.
You're a passenger in their car. Your only choice is to get out if you don't like where they're going.
That's it. And there are some regulatory storm clouds on the horizon for that car.
Big ones. The DOJ antitrust trials are still going on in the U.S.
And they just got hit with a $3.5 billion fine from the European Commission. These things create an overhang. Investors hate uncertainty.
So with all that spending and all those risks, how are they keeping shareholders happy?
With buybacks and dividends. They have a $70 billion annual buyback plan, which retires about 1 or 2% of the shares each year.
Makes everyone else's slice of the pie a little bigger.
And started paying a small dividend. It's not much, but it's a signal. It says, look, we're so rich, we can spend $93 billion on the future and still have enough left over to pay you directly.
It's financial fortress status.
It really is.
Okay, so let's bring it all back home, back to Buffett. If the stock is priced for perfection at $330 and the intrinsic value is maybe closer to $150, why on earth did he buy?
This is the absolute key. You have to look at when he bought. He bought in the third quarter of 2025. His entry price, based on the trading range then, was probably between $130 and $150 a share.
Okay. That changes the entire calculation.
It changes everything. At $130, the PE ratio was closer to 20. At that price, it was a classic Buffett value play. He saw the moat, he saw the infrastructure, and he bet that the market's fear about AI was overblown.
And he was spectacularly right.
He's sitting on something like 140% gain as of now.
So the lesson isn't buy Alphabet because Buffett did. The lesson is Buffett bought when everyone else was panicking.
He bought the dip. The deep value entry point was back then, not today. At $330, you're not buying a bargain anymore. You're buying a momentum train that's already left the station.
So, to sum it all up, where does this leave us on Alphabet?
It's a financial fortress that's trying to transition into an AI utility. It prints an unbelievable amount of cash, but the current stock price demands that this $93 billion bet on the agentic era pays off massively.
It's incredible. They're rebuilding the entire foundation of their business in real time.
They are. And let me leave you with one final thought to chew on.
Go for it.
We talked about this agentic era, right? Where the AI just does things for you. It plans the trip, books the hotel, buys the tickets. You never even visit a website.
Right.
So what happens to the ads?
Oh, that's a really good question.
80% of their revenue comes from ads. Ads depend on people looking at screens and clicking on links. If the AI does all the work in the background, nobody sees the ad.
So is this $93 billion investment the thing that saves the company? Or is it building the very tool that could eventually destroy its own business model?
That is the existential paradox at the heart of Alphabet right now.
A $400 billion paradox. Amazing stuff. Okay, before we sign off, we have to do the fine print.
Full deep value research reports can be found in the description links. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice.
Conduct your own due diligence before making investment decisions. If you want to listen our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe us on deepvalues.ai.
And don't forget to like this video. Much appreciated.
Thanks for listening, everyone.
We'll see you on the next deep dive.